Only about 58% of Americans own any stocks at all, and most of those who don't say it's because the stock market feels too risky or complicated. But here's the truth. Investing isn't about risk or luck. It's about ownership. When you invest, you're not gambling on numbers. You're buying a piece of the world's most productive companies. And that ownership, managed wisely, is one of the fastest ways to escape the grind. Still, it can feel like a gamble if you don't know what you're doing. Today, I break down the stock market, what it is, what it isn't, and most importantly, how to make it the secret weapon in your plan. Stay tuned. Welcome to another episode of Escape the Clock, the podcast where I, the author of the book, help you create a plan for financial freedom and the option to work on your terms. Today, I'm excited to dive into a topic I've been wanting to talk to for quite a while now, investing in the stock market. As I've mentioned on the show before, we all carry money values formed in childhood. You have yours, I have mine. If I asked you how you feel about the stock market, your answer might be tied in those early experiences. Maybe you think it's exciting, or maybe it feels risky, or maybe you think it's a little scary. The truth is, it's just a tool, just like any other. And when understood, it can be a powerful part of your financial freedom plan. So today, I'll break it down. I'll explain what the stock market is, how it works, and give you the fundamentals so that we can move into some deeper strategies later. I'll be talking about buying and selling stocks and options, and I'll be sharing my opinions along the way. So here's an important disclaimer. I'm not giving specific investment advice. Investing in stocks come with risks, and past performance does not guarantee future results. You might have heard this disclaimer before, and it's important, because it would be very easy for me to act like Jim Cramer and hype a stock saying stock XYZ is about to go to the moon. If it doesn't, that's no skin off my back. If it does, I might look quite smart, and you might have more trust in me when I talk about another stock in the future. That's the incentive some people have to promote investments that might not be right for you. The point is, there are thousands of companies and countless investment options, and where money flows, there's always opportunity for someone to take advantage. Understanding the market for yourself is the best way to stay in control. So, let's jump right in, starting with what even is the stock market. When you think about the stock market, what comes to mind? Ownership? Making money? Gambling? Wall Street? Stock bros? All of these ideas have some truth, but none of them really capture what investing in the stock market is. In the simplest terms, the stock market is really just a giant marketplace. Imagine a farmer's market. But instead of fruits and vegetables, people are buying and selling pieces of companies. When you own a share of a company, you literally own a tiny piece of that company. Instead of buying an apple at the farmer's market, you would be buying a piece of Apple, the tech company. Instead of consuming a piece of fruit, you'd hold on to that share that you'd acquire and sell it later, hopefully at a profit. Now, the stock market has two main purposes. The first, for companies. It's a way for them to raise money. By selling shares, a company gets cash to grow, hire people, and build new products. The other reason is for investors. It's a place to potentially grow your money by owning a piece of those companies that you believe will succeed. And all of those stocks that you're buying, they don't just float out in space. They trade on exchanges, big ones, like the New York Stock Exchange or the NASDAQ. We don't need to walk or call into the NYSE lobby. Instead, we can connect through brokers, apps, and online platforms, and it's never been easier. Well, it used to be harder. These brokers used to charge hefty fees for making trades, and sometimes it would be like $50 or more for a single trade. You can imagine how that would eat up a lot of what you might make. Now commissions are much, much cheaper, and for many types of trades, they can even be free. Additionally, you now have the option to buy fractions of shares. So you really want a piece of some hot stock that might be costing maybe something expensive, like $500 a share or more. Well, you can just buy a number of fractions for whatever price that you have to spend. And apps have gotten really smart too. Instead of calling in or going to a firm to make a trade, anyone can use easy apps like Robinhood or Fidelity or Schwab. You can even automate investing using something called robo-advisors with apps like Betterment or Wealthfront. And better yet, you are no longer limited to just US companies. You can trade in international stocks, ETFs, niche markets, real estate trusts, commodities like silver, gold, or even cryptocurrencies like Bitcoin. But I'm getting ahead of myself. Let's talk a little bit about the history of the market first. The stock market actually began in the 1600s with the Dutch East India Company allowing people to buy and trade shares. It spread to London and New York and then grew with industry, survived crashes, and evolved with technology and online trading. The U.S. stock market started in 1792 with only 24 brokers in New York. And over the centuries, it grew alongside the economy, surviving crashes and booms, and today it is a global powerhouse. With online trading, ETFs, and fractional shares, anyone can invest and ride the long-term growth that historically averages around 10% per year. So, the U.S. stock market has been around for over 200 years and has become a way for anyone to participate in real businesses and build wealth over time. So here's the million-dollar question. Why does a stock cost $50 today and $60 tomorrow? Well, the answer is really just about supply and demand. If more people want a stock than want to sell it, the price goes up. If more people want to sell than buy, the price goes down. But here's where it gets interesting. Prices don't just reflect what's happening right now. They reflect what people expect will happen in the future. That's why a company can be profitable and its stock price can still drop. It's all about expectations, not just about the reality of the moment. And that can feel a bit abstract. So I'm going to use a quick example and a quick call out to my daughter and her boyfriend for this inspiration here. But I wanted to give an example that could maybe be easy for a larger generational group to understand. So imagine there's this new thing called Pokemon. It's brand new. And most people don't know anything about it. But you decide it could be worth something someday. And there are a few Pokemon figurine companies. And each of these companies are selling a limited number of figurines. And each one only owns rights for a specific Pokemon. So the Pika company, Pika, is selling Pikachu figurines, and you decide, hey, this sounds interesting. I'm going to buy one of those for $10. But you also decide, hey, I don't want to put everything into this Pikachu. So you decide to buy one from the Bulba company as well, and you get a Bulbasaur figurine for $5. No one's really collecting these, and there's a very low demand. So the prices others are willing to pay is down at the moment. And so you see your initial investment of $15 not really growing and maybe even dropping by the day. But then Pokemon explodes in popularity and the demand for figurines increases. Since the figurines are limited, the price of having one suddenly goes up. And you see your $10 Pokemon figurine is suddenly trading for $60. And your Bulba figurine even goes up to $40. If you were to sell at the moment, you'd be making $85, $100 for the sale that you just made, minus the $15 that you originally paid to buy in. Then let's imagine Pokemon gets even more popular thanks to expansions and maybe even new figurines being introduced. And you decide this is the time to really buy into others, including an introductory offer of a new company called EVEE, who offers Eevee figurines starting at $50. Hoping that you'll see an increase, you decide to buy in. Additionally, you think, oh, okay, well, now more shares are available of the other figurines. So you buy another Pika figurine as well. So you have two of those, you have your Bulba and you have your Eevee. Your portfolio is now increased. Between your two Pikachus, an Eevee and a Bulbasaur, you have now spent an initial upfront investment of $125. But you forgot about these figurines and go about your life until one day you hear that they're trading at an all-time high. So you decide to check back and see what your portfolio is. You were wanting to take a big trip and you're hoping maybe you have a little extra cash and you log in and you see Bulba's now trading at $100, Eevee's at $220, and Pika's all the way up at $460 a figurine. For you, that's an entire account value of $1,240. That's a 100% increase in your returns. If you go ahead and sell, you would be giving up those figurines and collecting cash. If you hold, the price might go up even further, or it could fall. In this hypothetical, the price does continue to edge up, thanks to this bull market in Pokemon, maybe for another 2 years or more. But then a new figurine technology comes out, deprecating all older figurines. This creates a panic, and as people quickly sell their figurines, the price drops in response, which in turn creates more panic selling. If you had never sold, then eventually the Bulba figurine that you owned would only be worth $3. Your Eevee, $10. And your Pikachu figurines, $12 each. In that case, your portfolio would have come all the way back down to $37, which is a pretty large loss considering you had put a $125 investment in the first place. So, did you notice how the Bulba figurine ended up lower than the initial buy-in value, but the Pika stayed over? Spreading out ownership like this is a great strategy. It's called diversification. The more you diversify, the more you are protected from major swings, both up and down. For example, all the Pokemon figurines belong to the same sector, but they were hurt due to a technology change. If we had spread out even further, putting investments between, let's say, Pokemon figurines and, Naruto cards, then we might have been better diversified and protected. That roller coaster, that is the stock market. Excitement, fear, and greed, these can drive huge swings in value. Now look, this isn't a perfect example, it's just to make a point. Physical goods are traded on markets such as oil, gold, silver, cattle, etc. There's lots. That's called commodity trading. Stocks are pieces of ownership in companies, though. Holding them can feel a lot more abstract, and it can feel like there's an infinite number of shares available. The truth is that there's only actually a limited number of shares, but that ownership trades happen so often that it can feel like there's an unlimited amount. The price can be hard to understand as well. It moves up and down in sometimes unpredictable ways, which is why it can all kind of feel like gambling. But let's break it down a bit more. There are actually different types of stocks and investment styles. Not all are created equal, and some of them can be very smart strategies to make this really feel like you're making a smart money play and not just gambling. First, I want to talk about dividends. This is when companies pay out a portion of profits regularly. Basically, some of those profits are passed back to the shareholders, the people that own stake in the companies. It's an incentive for you to buy more shares. The more shares, the higher the payout. I'll touch more on it later, but know it's one of the best aspects of investing in the stock market and a major strategy for financial freedom. Next, there are growth stocks. These are companies that are expected to grow faster than average. Often, they don't pay dividends, because what they do instead is they take the money they're making, those profits, and they're actually reinvesting them back in their business in order to continue to grow. You can think of like tech startups, for instance. They have to keep making money so that they can keep putting it back in so they can keep growing. Alternately, there are value stocks. These are companies that are priced cheap relative to the profits or assets that they own. Investors hope the market will eventually recognize their value, and those cheaper buy-ins will become huge profits. Knowing that we have these three types of stocks, the ones that are undervalued and may grow big later, the ones that are supposed to grow now but may be more expensive, and the ones that pay you for owning them, then you might be excited to start buying in. And you should when you can afford it, and I'll touch on that in a minute. But first, I want to mention that there's actually multiple ways to invest in these different types of stocks. First is active investing. This is simply picking out a stock. Just pick one of those types you like, find one that you think will meet your goals, and you're just going to be trading in it. And most people think of day traders, and these like kind of suit and tie Wall Street bros making huge money from chasing the hottest stocks. The reality is actually quite different. Most day traders are just everyday people trying to capitalize on trends they see online or hear about from others. The truth, though, is the results aren't very pretty there. Studies show that only 1% of day traders consistently make a profit across 5 years, and only 13% manage to stay profitable over 6 months even. So in a given year, roughly 72% of day traders will lose money. Not surprisingly, many will just quit. About 40% give up within a month, and only 13% will remain doing it after 3 years. This isn't to say that active investing can't be done, though. Long-term investing is a strategy where you buy and hold a stock without the daily oversight that can lead to emotional reactions and those large losses. Historically, this strategy is more profitable and less risky. The S&P 500 is the 500 largest U.S. companies and has returned roughly 10% annually every year over the long term. Columbia Business School found that companies held by long-term shareholders outperform those short-term traders by 6% on average. The other way to invest is passively. So we talked about active, and a lot of that is either day trading or just holding, but there's also an option called passive investing, which is where you're buying index funds or ETFs that track potentially the entire market. There's lots of ETFs. I'll talk about them more as we go through this episode. This has much lower risk and historically sold great returns over longer periods. The reason this works and is so easy is that these funds are simply pooled collections of money from other investors, all managed by professionals to invest in a diverse portfolio of assets. Think of it this way. It's a professionally managed collection of stocks. So instead of buying into one company, you could be buying into many, many companies all at once. And this offers a few big advantages. First, resilience. Funds are typically balanced, meaning one big drop in a single stock won't wreck your entire investment. That diversification is your safety net. Second, they're professionally managed. You have people doing research and making moves that you or I would likely miss, trying to maximize returns. Now, there are a lot of type of funds out there. Mutual funds, hedge funds, money market funds, but we're going to focus on the most popular and arguably the most revolutionary for the everyday investor, which is exchange-traded funds or ETFs. Unlike other funds, ETFs are traded on exchanges all day long, just like a regular stock. They can also return dividends, which I'll continue to touch on as we go through this. And they really are just this simplified, diversified super stock. Because of ETFs, almost anyone can get into stock market investing successfully. But like everything in life, there is a catch. The first issue with ETFs is that they sometimes require a small fee to cover management costs, and that can eat into your returns. Second, you don't get to control exactly what stocks are in the fund. You're buying the whole basket. Finally, and maybe the most important, ETFs generally don't grow as fast as a standalone stock can. It's not a growth stock necessarily. Because of the diversification, some securities in that basket can hold back from growing fast. For every fast-growing company in the fund, there is likely at least another weighing down its growth. But remember, that is actually what we're looking for, and that's what makes it resilient. Let's touch on a concrete example for a second. Imagine you have $100 to invest. You could buy a single share of one stock, or you could buy fractional shares of some more expensive stock, or you could invest it into an ETF that will spread that $100 across dozens, maybe even hundreds of companies. So you might think it's a no-brainer. Buy the ETF, and you're probably right. For instance, if you were to buy into the ETF stock SPY, that covers the entire S&P 500. So with that single investment, you just bought into the top 500 most profitable companies in the United States. If you were to buy into VTI, you'd be covering nearly the entire US stock market. XLV would be getting you most of the big healthcare and biotech firms. FEZ, large European companies. EM would get you emerging markets like India and Brazil. The BND stock, that gets you the US bond market. GLD, now you're getting profits when gold does well, and which is a great hedge against the US dollar. So as you can see, there are lots of options, giving you a lot of control to build really strong and balanced portfolios. You can get diversification in almost any market or sector you want with a single ticker symbol. So in summary, there are three types of stocks: dividends, growth, and value, and two investment strategies, active and passive. Active investing in growth stocks is what most people think of when you mention the stock market. But the truth is, trying to chase quick profits usually does not work. Herd mentality and emotional decision-making often leads to losses, which is why long-term investing in ETFs tends to be safer and more rewarding. Now, let's be honest. The stock market is not a guaranteed way to make money. Prices fluctuate, sometimes wildly. Even the best investors lose money. But here's the thing. Historically, over long periods, like 10, 20, 30 years, the stock market tends to go up, not down. The advice is to buy in when it's low and sell when it's high. But how do you know that it's at its high? How do you know it's the right time to buy in? There are thousands of options to buy, all fluctuating by the minute. Brokerage firms like Fidelity and Schwab, Vanguard, Robinhood, they might show you 5,000 to 10,000 different options, including individual stocks, index funds, ETFs. How do you even know where to start? Well, first of all, maybe it isn't the right time to start at all. You only need a very small amount of money to open a brokerage account, as little as $50, but that doesn't mean that you can afford to invest yet necessarily. Some people will trade on margin, meaning that they do something called pattern day trading, which is where they're trading 4 or more trades a day using something called a margin account. These accounts have to have a minimum of $25,000 in them, even though that rule might be changing soon. But anyways, those traders can trade more because they're spending money they don't have. And they're hoping, because they're day trading, that they can make back more than they're spending, but they might get called, meaning that they're forced to settle all those trades they make. And if they haven't done well, that's where that $25,000 comes in. And that can be quite rough. And it was. Back in the dot-com crash, many margin traders went negative. And that's why FINRA put those new rules in place. Anyways, I'm not recommending trading on margin, not at all. You should be investing with money you actually have. The reason I brought that up is because, a lot of people who get in trouble are the ones borrowing and trading money they don't have and getting called on it. But knowing you can afford to lose the money, that's the trick. The reason day traders do this is because they're doing advanced strategies, though. They're doing things like shorting stocks. These are very high-risk strategies and not reliable for a financial freedom plan. Instead, focus on the cash flow you can afford to lose. Start with ensuring your emergency fund is secure first. Have cash for unexpected expenses funded in HYSA. This is so that you aren't forced to sell in a panic. You can absorb things so you don't go, oh no, I have to sell my stocks no matter what. Next, start investing what you can afford to lose and focus on low-cost index funds. Picking ones that cover the entire S&P, that's the best. It's spreading your money across the most profitable companies all at once. These are the ones that are most likely to turn a profit, and therefore you're increasing your odds that you will as well. Finally, you need to ignore the daily market noise, and there is a lot of noise. The goal is long-term growth, not instant riches. You'll see there is a lot of drama in the stock market, and it tends to reward those that are most patient. And again, that's why strategies like diversification, which is owning a mix of different stocks, and long-term holding are key. Don't put all of your eggs in one basket, and try not to check your portfolio every 5 minutes. With auto buys and thanks to compound growth and dividends, you'll be making progress to financial independence in no time. I want to wrap things up with some real-world examples. A little story, just to kind of outline how this can go. So imagine there's two friends, Ignis and Prompto. Ignis earns a high income as a successful chef at a trendy restaurant. He decides he wants to turn that into big money, so he starts investing a bulk of every paycheck in the stock market. He's trading every day, buying trending stocks and turning around some gains. He avoids dividends and instead focuses on a mix of growth and value stocks. Since the value stocks are cheap, he's buying thousands of shares and hoping they'll go big and he'll make millions. Using Morningstar reports and custom screeners, he continues trading every day. Pronto is a good friend of Ignis, but he's barely making ends meet as a photographer. Ignis tells him he should get into the stock market. And so he says, okay, I'm going to trust my friend, starts to save off 10% of each of the paychecks he receives for his work for investing. He doesn't like the uncertainty, and he also doesn't want another day job of trading stocks. So he decides to invest the cash into broad market ETFs. He decides it would be easiest to use a robo-advisor and have it automatically acquire new shares of the growth and dividend focused ETFs that he likes. They are highly diversified, and the dividends are set up to automatically acquire new shares. Once set up, he almost forgets about his growing portfolio and instead focuses on his photography business. A year later, the bull market takes a downturn. The economy is heading towards recession and a bear market has started. Stocks are plunging, and Ignis sees 25% of his entire portfolio lost overnight. In a panic, he starts selling what he can, moving to more conservative positions. He can't sell it all, though, since doing that would create too much tax, plus some of it in losses. And he doesn't want to realize those losses, so he debates which parts can he sell, which parts does he have to try to ride. He logs in the next day, and he sees that he's now lost 40% of his portfolio, and true panic sets in. He sells everything he can, even realizing losses and generating both short and long-term capital gains. Having day traded for the past year, he feels gutted by this turn in events, and he's lost his taste for trading. Pronto gets a panic call from his friend Ignis and logs in to see red as well. Instead of a 25% loss, though, Pronto sees that he's down 8%. Still, he's delighted to see how far his portfolio has gone and is seeing a new opportunity. Instead of selling, Pronto decides to update his robo-advisor and start buying into what used to be an expensive set of ETFs, which are now suddenly a lot more affordable. He frees up a little cash by selling a few positions, and balances into some bond ETFs and gold ETFs in order to have a little more resiliency. Then he logs off and forgets about it. 5 years goes by, and Ignatz needs some help from his friend. The restaurant's in trouble. They need cash to survive. Pronto's never had the means before, but wonders if his stocks might have the answer his friend seeks. So he logs in and he checks his account and he's floored. His ongoing investments have exploded thanks to a rebounded market and consistent contributions between his payments and the dividends. His original balance of $1,000 is now worth more than $90,000 and is still mostly green. He wonders if he could have done better if he'd rebalanced more often, but really is just happy that he gave it time to grow. Happily, he's able to cash out some of his highest yield long-term investments, staying in the 0% capital gain tax bracket. He's able to loan his good friend the cash he needs, pay no taxes, and know that his portfolio has plenty left to keep growing. Look, that was a long story, but it's one that I think many will relate to in one way or another, because the difference between Pronto and Ignatz was patience and discipline, because the market is unforgiving for those that don't abide to the rules, but it can be the greatest accelerator of financial freedom for those who understand it. Also, I touched on a few things in the story that I hadn't mentioned before, so I'm going to quickly touch on them now before we end. First, the trick to trading well is to do your research. That used to be very hard, and you'd have to depend on an investment analyst or a financial advisor to help make recommendations. But now things like Morningstar exist. They provide research, 1 to 5 star ratings, and analyst recommendations like buy, hold, or sell. There are plenty of recommendations everywhere, and running a ticker symbol through a report or even an AI or a web search box can help you learn a lot about it. Additionally, you can use these things called screeners, which will help you filter your stocks by criteria that match your goals. High growth, strong yield, historic performance, whatever you're looking for, you can find the ones that meet those goals. And with all this, you can hone in on stocks ETFs that work for you. The actual buying and selling part comes down to growth. In other words, you're looking for gains to make money. I'll cover other ways to make money next week, but this is about the basics. So first is something called the basis. This is the price you paid for the stock. Once you buy a stock, the price you paid becomes a reference point. You continue to compare the latest value to what you paid. Can't help it, it's just human nature. But this can cause panic selling or prolonged holding. Once you decide to sell, you receive a payout for whatever the value is based on the number of shares that you own. This is the price you sold it for, and the amount that you end up getting is the payout minus the basis. And if it's positive, then you have a capital gain. Otherwise, it's a capital loss. It's not honestly all that simple, though. You might think, great, I bought this thing for $100 and now it's worth $110 a year later, so I gained 10%. Well, you're right. That is how it would work in a year. But after multiple years, it gets different. Let's say you hit a winner and it's 20% the second year. Well, you might be tempted to say, well, okay, I got 10% the first year, 20% the second year. So the average return would be the 10% plus the 20% divided by 2, or 15%. That's actually called the arithmetic average return. And this can give you a really general idea of your performance, but it's actually not an accurate picture of how your money grew. The reason is because stocks have compounding force to them. Just like a savings account, they experience compounding growth. That means the gains from the first year are now earning returns in the second year, and you're earning returns on your returns. To calculate it, you have to actually run something called the geometric mean return. It's a more complicated formula, but it is the most accurate way to see how your money truly grew over time. Being able to calculate returns isn't what's important, though. That's not what I'm getting at. Brokers will do that. You'll get lots of reports. You'll be able to see the numbers. What I'm trying to get at is that things can compound both ways. A bad year doesn't just subtract a percentage. It compounds in reverse, eroding your hard-won gains. So imagine this scenario real quick. Year one, you had a stellar 50% return. So $100, not worth $150, you feel like a genius. But then the market tanks, you lose 40%. 40% on your $150 that you currently have is actually a loss of $60. So you end up at $90. If you had just run that simple arithmetic average return of 50% minus 40% divided by 2, you would think you had a 5% growth. But that's not true. That's not what happened. You actually lost money. 90 is less than 100. That's because the compounding worked against you in this case. And that is why investing can be so emotional. The threat of a single event wiping out all your gains from all those years It's always looming. So what can we do? How can we know how a stock will perform? The short answer is we never will. But what we can do is look at historical rates of returns. Even though past performance is never a promise of future performance, it can still give us a better understanding of a range of possibilities. This information is your best tool for deciding, plus all the other research you're able to gain. Should I sell? Should I hold? Since value will compound, the more we put in, the more it has to work off of. Dividends can make that easier as well. Seriously, dividends are one of the greatest things about investing. Just like investing in real estate where you're capturing rental income, stock market investing can create cash flow as well. I'll talk a lot more about that next week. But the more shares of a company you have, the higher the dividend payment will be. It's calculated based on a ratio and a payment schedule, which is usually quarterly. Now, if your goal is to cover a large percentage of your cost of living, the brutal truth is you're going to need a lot of shares, and that does take time. Luckily, some services offer something called a DRIP, or a dividend reinvestment plan. This is where your dividend pays out automatically and buys more shares of that stock that just paid out, further increasing the dividends the next time. It's an automatic snowball effect, compounding your way to your goal faster. Once you hit your target, you can turn off the DRIP and then just start taking the cash directly. So dividend can help with compounding in a big way. If you decide the time is right to sell and you're simply tempted to cash out because of the good returns, you'll be hitting the final consideration I wanted to touch on today, which is selling means income, and that means taxes. I know the word tax makes a lot of people's eyes glaze over, but just stick with me for a moment. This is actually really important because you can save thousands of dollars this way. Here's the deal. The government taxes your investment gains in one of two ways. One is the way you file your regular annual income. We call this short-term capital gains. The other is a special, often much lower long-term formula. Now, if you're already earning good money from your job and you decide to cash in on a big gain, that short-term tax can be a killer. Quick example here. Say you and your spouse make $200,000 for that year. That's your taxable income. That would put you in a 24% federal tax bracket, and you cash in $100,000 in stocks you held for 6 months. Well, it's all going to be short-term gains treated as ordinary income. That means your total taxable income went from $200,000 to $300,000. That would push you into the 32% tax bracket, making you owe an additional $30,000 to $32,000. That's a lot of extra money, plus state taxes if you have to pay those. Anyways, the golden rule is try to hold the asset for at least a year and a day. Once you've done that, your profit will become part of a long-term capital gain, which is actually taxed separately than your income. There are three main long-term rates: 0%, 15%, and 20%. And anyone really paying attention to me, ears would hopefully perk up at 0%. Let's use our $200,000 example again for a moment. Let's say that $100,000 of gains that had been cashed in actually was held for more than a year. Then it would actually mostly fall into the 15% long-term bracket. That's because it's more than the $94,050 criteria for married couples. So all the numbers are published. It's all in my book. It's all online. But you can see, depending on how you file your taxes, there's a certain number of gains that keep you in certain brackets. So instead of paying $30,000+ extra dollars, they'd only end up paying $15,000. That's a pretty big savings for being patient and selling something with long-term gains instead of short-term gains. But here's where it gets super exciting. You can actually do this very intentionally. If you are in a lower income situation, like an early retiree like me, or you're just having a low income year, maybe you're between jobs, you can actually start to harvest to stay tax free. So again, if you're filing jointly, there's that $94,050 range. Anything under that would be in the 0% taxes. So as long as you don't sell more than that number, you're not going to have to pay taxes on those gains. That is called tax gain harvesting, and it is a very powerful thing when it comes to financial freedom. Awesome. The takeaway is simple. Patience pays. Holding for 1 year and a day can save you a fortune. Before ending, I want to mention one last thing from the legendary investor Warren Buffett. Warren Buffett had many philosophies. He's been kind of shown to be a stock market genius. Anyways, he has this novel approach, which is about quality over hype. He looks for companies with strong competitive advantages, reliable earnings growth, and excellent management. He's not chasing the hot startups. He's investing in businesses that he can hold forever. The big idea is that if you get in early and the company has strong values, it's likely to take off eventually, and it's worked for him, and he's still doing it today. So where Pronto made it easy by focusing on ETFs that were well managed and gave it time to grow and saw real returns, you can try that strategy for yourself. It's been pretty proven to work at this point, even though there's never a guarantee. If this was a lot of information and a lot's bouncing your head and you're like, I'm not even sure what to do, you don't have to actually make all the hard choices. You can just kind of start with the easy path. You don't have to say, well, do I start with growth or reliability of an ETF? Here's the good news. Well, guess what? There's an ETF for everything. If growth is your goal, you can actually consider something like the VUG, the Vanguard Growth ETF, which is specifically managed to cover the top growth stocks. So you're thinking, I like this ETF thing. Growth sounds nice. Dividends rule. Well, you're right. That's what this is about. That's why I'm focusing on these topics, because let's get to the real strategies. Dividends, growth stocks, and ETFs can all work together in a single portfolio. Growth stocks and dividends are often opposites because growth companies tend to reinvest profits instead of paying shareholders. But you might find yourself saying, I want both, and you can have both. ETFs come to the rescue again here. They can combine these approaches by holding a mix of growth and dividend-paying stocks, giving you diversification, cash flow, and long-term growth. These holy grail stocks are ones that people are always having in their portfolios. You'll hear them in a lot of investment forums. These are things like VIG, the Vanguard Dividend Appreciation ETF, which focuses on companies that have a history of increasing dividend payouts with high growth companies like Apple and Microsoft. Then there's the SCHD stock, which targets US stocks with strong dividend yields and sustainable growth. And maybe one of the most popular is VOO, the Vanguard S&P 500 ETF. It has a fantastic mix of growth and dividend stocks across the top 500 companies. So if you ever hear VOO and chill, you'll now understand why. It's because you have that diversification and set it and forget it portfolio. Understanding funds, growths, and dividends is a huge step in building your financial future. What are you looking to start with? Pure growth or more reliable income? Okay, awesome. I think I've covered all the fundamentals, what a stock market is, how stocks, ETFs work, growth versus value, dividends, long-term investing. There's a lot here. And in part 2, we're going to dive into some real investment strategies focused on financial independence, showing you how to put a lot of these concepts into action. That's it for today's episode. If you're new to investing, consider re-listening before next week's deeper dive into financial freedom strategies. Remember, investing is a critical part of your financial freedom plan, but nothing I've said here should be considered personal financial advice. This episode is purely educational, is to help you review and refine your plan with a financial advisor. Before we wrap up, I'd love to hear from you. What was your first experience with the stock market? Share your stories in the comments. Best of luck investing in your financial freedom and escaping the clock. I'll see you next time. Thanks for tuning in to this episode. Remember, while I'm not yet a financial planner, I am getting my degree in wealth management. You should take anything you've heard here as tips and advice to making your plan. To learn more, visit www.escapetheclock.com. There, you can find the book, resources, including the planner, and you can even schedule time with me. Please remember to like and subscribe so you don't miss an episode. Thanks for tuning in, and I'll catch you next time.